Hello, everyone. Welcome to the weekly roundup. Today we will cover economic growth, interest rates, and market sentiments. Hello, Ben.
Hi, Eva.
How you doing?
Doing good. Happy to see the snow melting.
Yes, yes. But I feel is this snow melting there? Are we gonna see more snow tomorrow? I just feel like it's a facade. We're gonna see more tomorrow. I'm gonna wake
Yeah,
up and see white everywhere.
definitely possible.
I'm going back to sleep. Wake me up in summer.
I'm with you on that. I could hibernate through
No,
the winters.
absolutely. Okay, let's get right into it. I'm starting off with economic growth. The IMF forecast that this will cool slightly in 2026.
Hmm.
My question is, what are the main drivers behind the slowdown, and how can investors position themselves in response?
Yeah, so it's a good question. I mean, I think the economy is probably surprised to the upside here this year. And particularly in Europe, we saw interest rates being cut last year and have been on hold for a while now. So the economic activity was a little bit better than anticipated. Same in the US, like US consumption has been much better than expected. Um, the other area in the world, like China, also had cut rates and financial conditions got easier. So I think it was a better economic environment than most anticipated this year. I'd say Canada's maybe one of the few exceptions because our economy hasn't done quite well this year and, maybe temporarily recessionary numbers. So I think it's a bit of the fact that we had a bit of an overshoot this year and economic numbers were a little bit better. And the fact that maybe there's some slowing economic activity next year is what they're suggesting. It's a bit hard to balance that for me, just with the view that we will likely see lots of spending next year, particularly in the US. Um, China, I would say, will continue to be stimulative. And so I'd say rates will stay low there for foreseeable future. Their economic activity is picking up. So I think a bit of an overshoot is why IMF said that. I'm moderately optimistic that the economy will be a little bit better next year than maybe suggested this year. But I think, main question is, what does that mean to asset prices? And I think it means that more of the same, that we may not see the big run up that we have in certain areas, and maybe AI is a little bit frothy, but from a what happens to the market perspective, if more liquidity comes to the system, economic conditions aren't as bad as we thought. You could see still some reasonable upside in equities and maybe a bit of a rotation because I know we looked at some of the numbers this week from the market weight S&P versus the equal weight. And, we're super concentrated in the S&P 500, right? Those top seven companies are 22% the S&P and equal weight. Like if you owned all 500 companies, well, there's not 500 in there, but let's just say there were, and you equally held the positions in there. I think there's a real advantage maybe to switching out of some of the higher growth stuff into consumer staples and some of those names that are a little bit more attractive. So I'd say from a market perspective, maybe some rotation will be worth thinking about, and that's something we've been thinking about. But I'm not foreseeing some of the big blow-ups that you may catch in the headlines. And so I think that's a long-winded answer to your question is we maybe overshot this year, and then we'll see a little bit more moderate returns next year.
Okay. So with mixed signals from employment data, key reports have been delayed due to the government shutdown. The Fed is essentially flying blind heading into the December's meeting. So what are our expectations for interest rate decisions, and could this, data gaps influence their approach?
So I think it will to some extent. We saw the Bank of Canada come out with some news today, just saying they've looked through some of the choppy inflation numbers that have been coming out of the US. And so I would say, yeah, that the Federal Reserve will be in a similar challenge. I think that likely, if nothing's changed, that they will cut in December because that's the path and direction they were suggesting. I mean, the futures markets is a little bit uncertain right now, so I don't know what that number is right this second, but it was around 70% likelihood of a cut last time I looked at it. So I would tend to think they would lean towards more accommodative policy than less, given their uncertainty about what's going on. I mean, unemployment's been rising, and to some extent, debt levels are getting further extended and stretched. So I would think they would lean towards more accommodative policy, which is rate cuts. But fortunately, we got a bit of time, and as you know, the governments decide to go back to work today.
Good. That was a long one.
Yeah, it was.
Um, I know during the shutdown, liquidity was affected a bit. Was there any ripple effect of this in the financial markets? Were there any corrections?
I would say that's why we've been languishing here generally. And
Yeah.
so we've been fairly neutral. Markets have been sideways, choppy, really chop chop. And so I think, yeah, the money supply plays a big part into what happens. So we'll probably have an influx here, but from what is the market sentiment doing today? We're seeing a bit of correction here. You get Nasdaq down 2% and TSX down 1.5%, and I think the Dow's down about 1%. So, I think it's a bit of a maybe the settlement in the US isn't as great as everyone expected. And so markets are a bit choppy, but I'd say it plays a major part for what happens now. And so likely we're to see reasonable amount of liquidity come back to the system, maybe a bit of an influx as that happens. I think today's a bit of an anomaly just as markets resetting with the news settling. And I'd expect money supply to pick back up, and that'll be an important metric that we look at next month.
Okay.
Yeah.
I know you have some interesting charts for us. So
Yeah.
let's go into the charts.
All right. Sounds good. Well, we are, as per usual, we are recording this on Thursday, November 13th at around 1 o'clock. So anything that happens between now and next week, we'll comment on next week. So it is lucky number 13 today. So we get some excellent research from ISI Evercore, which is one of our research partners out of the US. And I know I like to talk macro quite a bit, and that's what we comment on often because inflation and growth are two major drivers for what happens to the economy. But just to give a little glimpse into some of the other things we look at, this first chart is, well, all the charts we're going to discuss today is from ISI Evercore's report. It's called the Teen and Young Adult Survey, just around what the different products that we use. And so this one is, what social media do you use most? I thought this is a great one. I think it's important to think about, not only from a stock perspective of what the potential opportunities are, but also for what is generally being used. And as you look at this chart, Neva, certainly I'm going to ask you your comments on these. But as we look at these charts, Instagram tends to be the chart that's most used by 13 to 36-year-olds. And so I'd say 36 to 50 would be interesting to look at as well, but that report hasn't come out yet. So this is 13 to 36-year-olds. Instagram continues to be the big one. But I think interesting, obviously, rate of change matters. This is quite a negative case. And, if you're an owner of Meta, which are these two companies here, this is a negative rate of change, which isn't great, but shows Instagram continues to be the leader. The one kind of standout here would be YouTube. YouTube is great, gaining a lot of traction, and so rate of change quite positive. For those that don't know, YouTube's owned by Google, so this is a positive within the Google family of companies that they're involved in, and then of course TikTok. So Eva, now you have to chime in and tell me which ones of these that you use most.
I mean, I'm still an Instagram girl. But I do understand YouTube. Most learning now is done on YouTube, so I do understand the increase, but I'm always gonna be team Instagram. Maybe WhatsApp, but Instagram.
Awesome, awesome. Thank you. So the next one I'd say we look at is streaming services. So um, video on demand for teen and youth adults survey. So this is streaming. And so I think, again, I think this is interesting. And it's worthwhile just thinking about who is the leaders in the space. And, if you look here, Netflix continues to be a big driver of this. And if you read in a little bit deeper into this research report, the head analyst on this report says Netflix has lots of potential upside and opportunities. A bit surprising for me as we're seeing a decline in that in their leadership, but it does appear that they continue to hold major market share. It allows them to put good content out there. The other, well, you'd see HBO Max is getting attention. But for me, as I'd look at Amazon Prime, they started well, have dropped a bit, and now starting to gain and get some traction back again into that space, putting up good content and link to some of the other video providers. And, certainly not too many people 13 to 36 has ever used cable, so this will be an important thing to think about for where the attention goes and where the money's to be made. So I thought this was a great report there. Eva, you can also give your comments on which ones you use as well, please.
I think I'm the contrarian here because I would pick Amazon Prime over Netflix.
Okay.
So it is Amazon Prime for me.
Better content.
Yeah, variety.
Okay.
Mm,
Okay. Fair enough. I think I probably would as well. I think there's some good stuff on there too. Crave's not on
yeah.
here, so I don't know where Crave would fall into this. Do you know?
I think Crave is listed on Amazon Prime as well.
Okay.
So you can get it through Amazon Prime.
Okay. Excellent. Thank you. Jump on. We got a couple of more. This one, certainly I have my thoughts and feelings on this. And this is, what is your favorite quick service restaurant chain? So obviously you can look at along the top line, this is the cumulative numbers. So that is Chick-fil-A was at the top of the charts until this year. They dropped down to second with Chipotle being number one in 2025. If we look down along the bottom here, we'd look in the different age groups to see what's up top there. Looks like it's pretty split between Chipotle and Chick-fil-A. On at least in my household, I would say that Chick-fil-A, Chipotle would definitely be up there. If the kids are looking for something to have fast food on, and for me, Chipotle would probably be higher than Chick-fil-A. Eva, what about you?
Chick-fil-A for me. I absolutely agree. Chick-fil-A takes the lead for me.
Nice, nice. I think it's interesting. I mean, I think it's worthwhile thinking about this, certainly from where the opportunities are, where these businesses are doing well too. And so yeah, good to see both these companies have come to Ottawa recently, with Chick-fil-A has only recently come to Ottawa, and it's getting a lot of traction. And then the last one just on clothing, and I think this just really gives you a sense of what's working here and must-have brands, I guess. And so most of these would be clothing, obviously with Apple being the standout in that category. But if you look along the top the two levels, so at least in the first age group, it was Lululemon for 22, 23, 24, and then 25. Even I had to look this up. Aloe is looks like a competitor to Lululemon, so it's a high value brand yoga wear type product. And then Apple continues to gain a lot of attention. That's actually interesting because it dropped off the board in 2024 and has jumped back up into one of the top spots here in 2025. So also interesting from that perspective. When I look at these, because I'd look at these from an investment perspective too, and Nike and Lululemon, both their stocks have been beaten up. And so if we see them start to pop back up into the high end of this area, that's probably a good sign. So maybe the stocks have bottomed and there's an opportunity there from a perspective of where to make money. And so I think that was interesting. So Eva, any of these brands you like best over others?
I mean, I do have to check out Aloe. Like the ranking, I've never heard of it before. But I mean, Lululemon remains a standout for me, and Nike.
Okay. Okay. Excellent. Yeah, I've been a Nike fan my whole life, and that's the only running shoe I wear,
Nice.
and my kids. All right. Well, just as we jump onto this, as always, the opinions expressed do not necessarily reflect those of National Bank Financial. Should you have any questions or comments, certainly feel free to reach out to your advisor, to myself. Happy to address. Everyone's risk tolerance is different, and don't construe this as investment advice.
Awesome. Thank you, Ben. I'd like to see the charts from, 36 to 50, thereabouts.
So would I.
Sort of.
Yeah.
Great. So what's on the agenda for next week?
Yeah, I think now that the government shutdown's passed, that'll be important to see what happens. Do we get a bit of calm now and go back to, we'll say, work, so to speak? Um, the US government has this artificial debt ceiling that they continue to push up against to. And so, that's effectively all this has done is kick the can down the road a couple of months. But it'll be interesting to see what happens. Do we go back to work? Data start to come out? Um, Government start to refocus on, we'll say, trade and tariff war that they've been battling prior to this. So I'd be looking at that. Earnings starting to come to a close as well, so we continue to look at earnings, and certainly there's been mixed reports that have come out. Disney had a weekend forecast today, so stock was down 7-8%, but Cisco had good earnings and they're up 7-8%. So certainly the stocks have been moving quite significantly on that. There's been a few takeouts in some of the companies that we follow, so I'd see if there's more M&A still coming. But really, I'd be interested to see what happens. Markets come back to work, liquidity comes back into the system, and what happens now. So I'd be watching those things quite closely.
Okay. Sounds good. Thank you, everyone. Remember to visit, subscribe, and follow us on YouTube and LinkedIn at Hart Investment Group. The link to our daily financial heartbeats will be in the caption of this video and in your email box if you're subscribed. For our clients, please reach out to me if you have any questions or if you'd like to book a review meeting with Ben. Thank you for listening and have a good weekend. Bye.
Thanks, everybody. Bye.